Big news making the headlines today that we just experienced the best economic growth over 1 year since 1984. How ironic. So in this video, we are going to look at number 1, is it true? And number 2, what did it cost? Ready? Let's dive in. All right, guys, so we can see in this article, fiscal stimulus powers the U.S. economy in 2021 to its best performance since 1984. So what are the numbers? Fourth quarter GDP increased by 6.9%. That gives the year overall growth of 5.7%. And if we take a look at this chart from CNBC, we can see the breakdown by quarter here, what the change from the previous quarter looks like. So obviously after, quarter 2 of 2020, you're going to have a giant spike because it's changed from the previous quarter here. And this little 6.9% here was much more than what was expected. And so that has driven the annual total up. So let's take a look at the data and see what's going on here, see what drove these numbers. First thing we are going to look at is just the total GDP number. So what I want to do is I want to take a look at this in light of the drop in GDP from that happened at the beginning of 2020 here. So if you take the total before the decline started at the end of 2019 and you go all the way up to where we're at right now, you're going to get a difference of just under $2.3 trillion. So our GDP from the end of 2019 through the end of 2021 over that 2-year period increased by just about $2.3 trillion, just under that. It's important to remember, $2.3 trillion. Now, if we take a look, and just in case anybody's wondering, the real GDP number is what's being talked about here, 5.7%, 5.67%. This is adjusted for inflation. Real domestic product is inflation adjusted. And so the non-inflation adjusted number is, north of 10% or something like that. And so the 5.7% number that they're saying is breaking all the records since 1984 is adjusted for inflation. But again, this is important to keep in mind. It's adjusted for the official inflation numbers, the official CPI. And I've gone into this so many times, so I'm not going to go into all the details, but your inflation numbers are probably higher than what the CPI reports. And there are some built-in incentives to have the CPI show a little bit lower than what most Americans actually experience. And so when you account for what the true inflation rate is, which is different for everybody, the GDP is probably not anywhere near 5.7% growth over the last year, but you can see this dip here from 2020 and then the spike in 2021. All right, now I'd like to take a look at the federal debt as a percent of GDP. This is important to look at because we saw this debt spike to 135%. After, in the fallout of all of the borrowing that the government took on to spend in 2020. Now, this is important because many economists look at 90% debt to GDP as the number that you can't grow your way out of. So below 90%, many times, the government is able to take on more debt and spend that money into the economy. And that money that they spend into the economy is able to cause enough growth to basically pay for that additional debt. And they say once you get above 90%, which when was it that we passed 90? All right, 2011, 2010 was when we passed that 90 mark. That's where they say it's very, very difficult, many times not possible, to grow your way out of that debt load. And then they also say, the same economists, Reinhard and Rogoff, who wrote the book This Time Is Different, say that once you pass 120%, that's kind of the point of no return. So we passed that. Now, one thing you'll notice is this debt to GDP number has been falling since then, which would indicate an improvement. You're getting growth. The reason for that is because it takes time for all that debt to be spent and then to work its way throughout the economy. So there was big borrowing, but at that point, all you had was an increase in debt. No spending, no new money entering the economy. As that money is spent and works its way throughout the economy, then you have additional spending from economic actors, investments in inventory, which is the biggest piece of the GDP growth. You're going to see a fall in this number because you haven't had the corresponding spike in debt as that money is spent into the economy, spent throughout the economy, bidding up prices, and you're so you're seeing a fall in the ratio because GDP is now growing as a result of that debt now entering, that spending now entering the economy. This chart only goes through quarter 3. So I would anticipate a sizable drop in this number, probably below the 120 mark. Now, keep in mind that's still well above that 90% mark that economists agree it's very, very difficult to grow your way out of, which would indicate doesn't matter if we're seeing this ratio drop. That would indicate that at some point a problem will come up because of that debt that will require additional debt, additional spending that will cause another spike like this, that the growth can't outpace the growth of GDP can't outpace the growth of debt in the long run once you pass that 90 mark. And so you're going to continue to see spikes like this until it just becomes, gets unsustainable and it collapses. Now, the raw numbers here, the total numbers that we're looking at, this is the total federal debt. Let me zoom in. So these are the total numbers. We're looking at $23 trillion was what the federal debt, the national debt was at right before they took on all the additional debt in 2020. Since then, it's increased to a little over 28 trillion. And so we've seen a little over a $5 trillion increase in the total debt since they started spending all the extra money to deal with the last couple of years. The reason why that $5 trillion number is significant, remember back here, the GDP increased by how much? 2.3 trillion. So the government borrowed a little over 5 trillion and caused an increase in GDP of about 2.3 trillion. This is where we're starting to see the answer to the question, how much did it cost or what did it cost? Where did they borrow that from? If you take a look here, let me zoom in. This is the Federal Reserve's balance sheet. So we see federal debt spiked from 23 trillion to 26 trillion. So that was about $3 trillion of borrowing all at once. Let's go over here to the Federal Reserve's balance sheet. Not there. Federal Reserve's balance sheet here went from a little around 4 trillion to over 7 trillion, $3 trillion. So the government borrowed $3 trillion. Federal Reserve's balance sheet expanded by $3 trillion. That's called debt monetization. That's when the central bank prints money to loan to the government. That's what this was here. They bought all that government debt. That's loaning new money coming into existence to the government. And yes, it's indirect. Yes, it has to go through the banking system first. No, that doesn't matter. Yes, it's still debt monetization. The central bank prints money, loans it to the government so that they can spend. That has caused, well, let's look at the totals. So that was just the spike. So we got a total from 4 to 8, almost $9 trillion. So almost $5 trillion increase in the Federal Reserve's balance sheet. And then when we look back at federal debt, total federal debt went from 23 trillion to 28 trillion. $5 trillion increase in the national debt. $5 trillion increase in the Federal Reserve's balance sheet. See where I'm going here? Federal Reserve is printing money. It's going to the government. That's loans made to the government. And then that money is getting spent into the economy. And if we look here, we can see where it's influencing the total money supply. We went from 15 trillion as the total money supply as measured by M2 until, well, we had the initial spike, got us to 18 trillion, which was 3 trillion difference, to where we're at now, which is 21 trillion. So we went from 15 trillion to almost 22 trillion. So we had, $6-7 trillion increase. Now, you'll notice that's more than what was spent or borrowed by the government. That's more than what was monetized by the Fed. So where did the rest of that expansion of the money supply come from? Where did it come from? It came from an increase in debt. If you'll notice here, we didn't have any deleveraging. Debt has continued to increase for households. If you notice here, We didn't have any deleveraging. We've had an increase in debt from corporations. So the additional borrowing that has taken place, plus the additional spending that has been funded by government borrowing from the central bank, has contributed to a massive expansion in the money supply. That money supply increase has been working its way throughout the economy, bidding up prices, leading to a spike in GDP, because GDP is calculated as basically the total price, what's included in the economy. And so obviously you're going to get a spike in GDP. But the key thing here to recognize is the diminishing returns. How much did GDP increase by over that time? About $2.3 trillion over the last 2 years. And that was far less than the amount that the federal government had to borrow and spend into the economy over that same time period. And it was far less than that plus what people did, which was borrow and start spending that money. All that will contribute to increasing prices over time. And the key thing to remember is increasing prices lead to growth in GDP because of how GDP is calculated. And so we're seeing in real time here, we're seeing diminishing returns, where we're at this point where you have a crisis, you spend, you see a ballooning of GDP a year, 2 years later, and it's diminishing returns. You're not getting the same bang for your buck. You're getting 50 cents, 30 cents on the dollar. Next time around, you get even less. And then eventually you get to a point, I don't know when that point is, but eventually you get to a point where every additional dollar of borrowing that you spend into the economy as the central government, you actually cause a destruction of wealth. Those diminishing returns start to turn negative as the burden of servicing that debt becomes so large that it is unsustainable. And again, it's not just the government, that's a big part, but it's also household and corporate debt. And so those are big two players there. We're seeing diminishing returns. And the longer this continues, the more those returns, the return on each additional dollar spent that's been borrowed or printed into existence, you start to get 30 cents, 20 cents, 10 cents on the dollar return until it eventually turns negative. That's the point of no return. That's the tipping point when things really start to collapse. Hope that makes sense. Let me know if you have any questions in the comments section below. And I do want to mention, I'll be speaking at an event in Dallas on March 5th. If you're interested in attending, I'd love to see you there. Check out the details. Link is in the description below. As always, thanks so much for watching. Have a great day.